There's a line on your chart you've drawn 100 times. Price falls toward it, pauses and bounces. Falls toward it again weeks later, pauses, bounces again. You call it support, and you treat it like a law of physics, as if there's something in the price itself that stops falling there. But there is nothing in the price. A number cannot hold another number up. What's actually happening at that line has nothing to do with the market and everything to do with the people trading it. That line is not where the price stops. It's where a specific group of human beings feels a specific emotion so strongly that they act on it, all at once in the same direction. Support and resistance are not levels. They are memories. And once you can see the memory underneath the line, you stop reading charts and start reading people, which is what every great trader was actually doing the whole time. John Murphy wrote the book that taught a generation how to read charts, and support and resistance is the foundation everything else is built on. But the textbook definition, a level where buying overcomes selling, tells you what happens without telling you why. The why is the whole game. So let's go underneath it. Every price on a chart is a place where somebody made a decision they now have to live with. Someone bought there. Someone sold there. Someone watched it and did nothing there, and then regretted it. A chart is not a picture of a company or a currency. It is a map of decisions, and more precisely, a map of the emotions those decisions left behind. Price doesn't remember. People remember. And when price returns to a level where a lot of people made a decision they feel strongly about, those people act. And their action is what we see as the bounce. The line works because the pain is real. Let's build a support level from scratch, one human at a time. Because once you see it built, you can never unsee it. Price is falling. It reaches a level, call it 100, and it stops and turns up. Now, 3 different groups of people are watching that turn, and each one is having a different emotional experience. First, the people who bought right at 100 and are now in profit. They feel smart. They feel validated. If price ever comes back to 100, they want to buy more because it worked last time. Second, the people who bought earlier, higher up, and wrote it down through 100. They felt fear on the way down, and when it bounced, they felt relief. If it comes back to 100, they want to get out at break even, but many will hold, hoping. Third, and this is the important group, the people who watched it bounce off 100 and did nothing. They missed the move, and missing it hurt. They told themselves, if it ever comes back to 100, I'm buying, I'm not missing it twice. Now watch what happens when price returns to 100. All 3 groups act at the same moment, and all 3 act in the same direction. The first group buys more because it worked. The second group finally gets their break-even exit or hold with hope. And the third group, the regretful ones who missed it, they pile in because this is the second chance they swore they wouldn't waste. Buying overwhelms selling, and price bounces again. To everyone watching the chart, it looks like the level held, like there's magic at 100. There's no magic. There's just a crowd of people all feeling the consequences of an earlier decision, and all reaching for relief at the same price. Support is not a floor. Support is the sound of regret being resolved. And the more times price bounces off a level, the stronger it gets, not because the level is magic, but because each bounce creates a new batch of people who profited there and a new batch who missed it, and both groups are now waiting for the next visit. Resistance is the mirror image, and it is built out of the most human emotion of all, the refusal to accept a loss. Price is rising. It reaches a level, call it 200, and it stops and turns down. Who's watching? The people who bought at 200 right before it fell. They're now trapped in a loss, and they feel something very specific. Not fear yet. Hope. They tell themselves it's just a pullback, it'll come back, I'll get out when I'm even. This is the single most expensive sentence in trading, and millions of people are saying it at once at every resistance level on every chart in the world. Now price falls and then slowly climbs back toward 200. What do those trapped buyers do as it approaches their entry? They get ready to sell, not to profit, to escape, to get out at break even and in the stress. So the moment price reaches 200, a wall of relieved sellers dumps their positions, and price turns down again. Resistance is not a ceiling. Resistance is a crowd of trapped people all trying to get out the same exit at the same time. And here is the detail that turns this from a nice metaphor into a tradable edge. Once you understand that resistance is made of trapped buyers waiting to break even, you understand exactly why a level breaks. A resistance level breaks when the trapped sellers have all gotten out. Once everyone who is waiting for break even has escaped, there's nobody left to sell, and the smallest amount of new buying sends price straight through. This is why breakouts happen on volume, something Murphy hammered on. The volume is the sound of the last trapped sellers being absorbed by new buyers. And it's why a level that breaks so often becomes support on the way back down. All those trapped sellers who finally escaped at 200, they're now watching from the sidelines, and if price comes back to 200, some of them feel the old regret, the one that says I sold at break even and then it took off without me, and they buy. The ceiling becomes the floor. The textbook calls this the principle of polarity. What it really is the same crowd feeling a new regret at the same price. Let me walk you through one complete example, slowly, because seeing it happen once end-to-end changes how you read every chart afterward. A stock has been stuck under $50 for months. Every time it approaches 50, it turns down. Now, who is that $50 line made of? Two crowds. The trapped buyers from the last few runs, sitting in small losses, whispering I'll get out at 50. And the watchers, the ones who've seen it fail at 53 times, who now believe 50 is a wall and are waiting to short it. So price approaches 50 a fourth time. The trapped buyers sell to escape. The shorts pile in, and it turns down again, confirming everyone's belief that 50 is the ceiling. Belief is now maximum, and that is precisely the moment it's most likely to break, because maximum belief means everyone who is going to sell at 50 has already positioned. Now, imagine a wave of new buying arrives. The trapped sellers are already out. The shorts, watching 50 break, panic because a short's loss is unlimited and their stops sit just above 50. Their stops trigger, which means they have to buy to cover, which adds fuel to the very breakout that's hurting them. Price doesn't drift through 50. It explodes through it, powered by the forced buying of the exact people who were most certain it would hold. That explosion has a name on the chart, a breakout, but its cause is human, a crowd's certainty becoming its own undoing. Now let's connect this to the traders and market wizards, because none of them thought of themselves as chart readers. They thought of themselves as readers of other traders. Marty Schwartz was explicit about it. He said he used the moving average and other tools, but what he was really doing was trying to figure out where the losing traders were trapped, because that's where the fuel was. When you know where a crowd is trapped in a loss, you know where they'll be forced to act, and forced action is predictable in a way that free choice never is. Paul Tudor Jones talked about knowing where the stops were, where the pain points at on the chart, because those are the levels where a small push produces a large move, as everyone stops trigger at once. This is the same insight as support and resistance, taken to its conclusion. The chart is a map of other people's regret, fear, and hope, and your edge is being one level more objective than the crowd that's emotionally pinned to those levels. Bruce Kovner said something that fits perfectly here. He said he placed his stops at points that the market should not reach if he was right, and crucially, at points other people would consider obvious, so he could get out before the crowd was forced to. He understood that obvious levels are dangerous precisely because they're obvious, because everyone is watching them and everyone will act at once. The amateur sees a clean support level and thinks, safety, I'll put my stop just below it. The professional sees the same level and thinks, that's where 1,000 amateurs put their stops, so that's exactly where price will be pushed to trigger them all before reversing. Same line, opposite reading. The difference is not the chart. The difference is understanding that the chart is full of people, and people in pain are predictable. This is why Murphy's technical tools and Douglas's psychology are not two separate subjects. The technicals are a map of the psychology. You cannot fully read one without the other. And there's a beautiful piece of evidence for all this hiding in the trend followers, the wizards who claim to ignore psychology entirely. Ed Seykota and Richard Dennis built fortunes on systems that mostly bought breakouts, price pushing through resistance to new highs. On the surface, that sounds purely mechanical, a computer buying a number crossing another number. But ask why buying new highs works at all, and you land right back in human regret. A new high means every single person who owns that asset is in profit. Nobody is trapped. There is no overhead supply of relieved sellers waiting to escape because everyone who bought is happy. And on the other side, everyone who sold too early, who took profits and watched it keep running, feels the regret that says I got out too soon, and many of them buy back in, adding fuel. A market at new highs is a market with no trapped sellers above it and a crowd of regretful early sellers below it, which is the cleanest possible setup for continuation. The trend followers weren't ignoring psychology. They built machines to harvest it at the exact price where the regret ran only one direction. Murphy's chart and Seykota's system are describing the same crowd from two angles. Here's a small piece of evidence that support and resistance is psychological and not mechanical, and once you notice it, you'll see it everywhere. Round numbers. Price reacts at 100, at 50, at 1,000, at 20,000, far more than at 73 or at 11,417. Why would a market care about a round number? The market doesn't. People do. We set our targets at round numbers. We set our stops at round numbers. We say I'll sell if it hits 100. Never I'll sell if it hits 97.4. So round numbers become gravitational. Not because of anything in the asset, but because millions of human beings independently chose the same clean figure to attach their hopes and fears to. Round numbers are proof that the levels are made of us. They're the places where the largest number of strangers happen to feel the same thing at the same price. And that shared feeling becomes a wall you can trade against. Now let me give you the hard part. The part that separates people who know this concept from people who can use it. If support and resistance were simply reliable, everyone would trade them and everyone would win, which means they can't be simply reliable or there'd be no market. So here's what actually happens at an obvious level and why it breaks so many traders. Everyone sees the same support at 100. The amateurs buy right at 100 with a stop just below at 99. Now think about where the fuel is. There's a pool of stop orders sitting just under 99, hundreds of them stacked. To a large trader, that pool of stops is not a risk. It's a target. It's free liquidity. Price gets pushed down to 98. All those stops trigger, they become forced sell orders. Price spikes down on the panic. And then, with all the weak hands flushed out, it reverses and rockets back above 100. The support level held, eventually, but everyone who traded it the obvious way got stopped out at the bottom first. The level was real. Their understanding of it was shallow. This is the difference between knowing support exists and understanding what it's made of. The shallow trader thinks the line is a wall. The deep trader knows the line is a crowd, and that crowds get flushed before the move they predicted actually happens. So the deep trader doesn't buy at the obvious level with the obvious stop. He waits for the flush. He waits for price to stab below the level, trigger the panic, and then reclaim it, because that reclaim is the signal that the trapped sellers are gone and the regret buyers are stepping in. Mark Douglas would frame it this way: the amateur is trading his own hope that the level holds, while the professional is trading his red of everyone else's fear. One is inside the emotion. The other is watching it from above. And the only thing standing between those two traders is the understanding that a chart is not lines, it's people, and people telegraph their pain. So let's make this practical, because a concept you can't act on is just entertainment. 5 practices for trading support and resistance as human regret instead of as magic lines. 1. Stop drawing lines. Start asking who's trapped. Every time you mark a level, say out loud who is in pain here and what will they be forced to do. If you can't answer, it's not a real level, it's just a place price happened to be. A real level has a crowd behind it with a reason to act. 2. Expect a flush. Assume the obvious level will be violated briefly before it works, because the stops under it are fuel and someone will reach for that fuel. Don't put your stop where everyone else puts theirs, just under the level. Put it where your idea is actually wrong, which is usually further away than feels comfortable, or wait to enter until after the flush has happened and the level has reclaimed. The crowd stop placement is not your stop placement. That single adjustment saves more accounts than any indicator. 3. Respect volume, because volume is the crowd's conviction made visible. Murphy's rule holds: a breakout on high volume is the sound of trapped sellers being absorbed, and it's far more likely to hold than a breakout on quiet volume, which is just price drifting through a level nobody's defending yet. When a level breaks on heavy volume, the regret has changed hands. When it breaks on nothing, be suspicious. The trapped crowd may still be waiting. 4. Trade the retest, not the break. The highest quality entry is rarely the breakout itself. It's the return to the broken level afterward, the polarity flip, when the old ceiling becomes the new floor. That retest is the moment the crowd's regret is freshest and clearest. The people who miss the breakout are watching that exact level, praying for a second chance, and when price returns there, they act. You're not predicting. You are waiting for a known crowd to do the thing they always do at the place they always do it. 5, and this is the one that ties the whole channel together. Use this understanding on yourself first. Every level on the chart is made of other people's regret, fear, and hope, which means you're also a data point on somebody else's chart. When you're holding a loser at resistance, praying for break-even, you are the trapped seller. When you're chasing a bounce because you missed it last time, you are the regret buyer. The same emotions that build the levels are operating inside you while you trade them. So the real edge isn't just reading the crowd's pain. It's being the one person at the level who is not ruled by it. That's what every wizard actually had in common. Not a better chart. A quieter relationship with the same feelings everyone else was drowning in. I want to be honest about how this skill develops, because it doesn't arrive all at once, and false expectations make people quit right before it clicks. At first, you'll draw your lines and still get flushed, and you'll think the concept doesn't work. It works. You're just still trading the line instead of the crowd behind it. Then you'll start seeing the flush coming, but too late after it's already stopped you out, and that's maddening, but it's progress. You're now watching the mechanism instead of being blindsided by it. Then, eventually, you'll feel it before it happens. Price will approach an obvious level, and instead of thinking safety, you'll feel a small alertness that says everyone can see this. The stops are stacked, wait. That alertness is the whole skill, and it's quiet, not dramatic. Expect to regress too, especially in fast markets or after a good run, because confidence makes you lazy and you'll start trusting lines again. That's not failure. That's the old habit asking for its job back. The Wizards didn't feel this stuff more than you. They just spent years being 1 degree more objective, one flush at a time, until objectivity became the reflex. Let's stand back and look at what we've really said. Support is not a floor. It's a crowd of people resolving an old regret at the same price. Resistance is not a ceiling. It's a crowd of trapped buyers all reaching for the same exit. Levels break when the trapped are finally gone, and old resistance becomes new support because the same crowd feels a new regret at the same number. Round numbers work because we all reach for clean figures, and the obvious level gets flushed before it works because a pool of visible stops is fuel to anyone big enough to reach for it. None of this is on the chart. All of it is in the people. Murphy gave us the map. Douglas told us it was a map of the mind. And the Wizards traded it by staying 1 degree more objective than the crowd whose pain drew the lines. So here's what I want you to carry out of this. The next time you look at a chart, I want the lines to disappear and the people to appear. See the trader who bought the top and is praying. See the one who missed the bounce and is furious with himself. See the 1,000 stops stacked just under the obvious level, waiting to become someone else's opportunity. Because the moment you can see them, you've stopped being one of them. That's the whole art. Not predicting the market, reading the humans inside it, and being the calm one at the level where everyone else is losing their composure. If this changed how you see a chart, tell me in the comments. What level are you trapped at right now in a real trade? Praying for break-even? Name it. Naming it is how you step outside it, and your honesty gives the next trader permission to admit theirs. If it helped, share it with one trader who keeps getting stopped out at the exact bottom, because this is the video that explains why. Subscribe if you want to keep going, because we've only started reading the chart as what it really is, a mirror of the crowd. Next time, why the trend is the single most powerful force in markets, why fighting it feels so intelligent and pays so terribly, and how the Wizards made fortunes doing the one thing that feels most uncomfortable, holding on. Until then, remember, the line isn't where price stops. It's where people break. Don't be one of them. I'll see you in the next one.